Hi everybody, my name is Christopher Matugas. I am with CI Investments. Today I'm going to go over my presentation, Construction of the Modern Portfolio. I believe that this presentation is best used with advisors who are thinking about transitioning or in the early stages of transitioning their book of business from a traditional transaction account to fee-based. Love to hear any feedback you may have. Please do send me an email or call after viewing this presentation. I'm going to start off with a quote here, and I put the real person that this is attributable to at the bottom. Most people, after reading it, would think and think falsely that this was attributed back to Darwin. In actual fact, Leon Megginson read Darwin's work and then applied it to business and marketing. I think this is very important and why I liked having the right person on there, because as we go forward, there's going to be a lot of data points out there. There's going to be a lot of information out there. This is just one of them, and whoever does adapt to the changing environments will survive. So I start off the workshop with a worksheet, and the basis of it is really to get everyone on the same page. So the first worksheet just has advisors really pin down the terms. So I ask, what is an ETF? And for the most part, when they write down their answers, it's typically a passive index investment. And what I tried to get them to understand is that is no longer the case. ETFs now should be thought of as investment delivery vehicles. There is a full spectrum going from passive index ETFs to full-on active ETFs, where here at CI Investments, at least, we already have two fully active portfolio managers creating brand new active ETFs. Again, I get them to shift their mind space, so already trying to disrupt their thinking of how things should be, so that they understand that the industry has changed quite a bit. And even though we're in the infancy of the ETF industry, maybe the toddlerhood of the ETF industry, there's tons of changes that are happening already. So the agenda is, again, setting the baseline. I want them to understand and have the correct terminology in their head. What that means is we all are speaking the same language. I'll go over some of the index and passive strategies, explanation of smart beta, exploring and incorporating alpha strategies, and incorporating the language of implementation used throughout. So really helping them have the words to use with their own clientele as they transition from their clients' accounts from a transaction account to a fee-based account. So helping them have the correct words in order to do that. So when I think about the industry, I think about it this way right now. CRM2 is leading to fee compression, which means that they're going to need more assets to make the same amount of money. That tells me that you're going to have to make an efficient business that is scalable. You need to have that scalability, which means, in my mind, I've seen two models out there for running an efficient advisor practice, which is a FOF or fund-to-fund or a model business. So why do I say this? Well, over the past in 5 years, and acceleration over the past 2 to 3 years, there's been a bifurcation of the industry, where here are all the terms that you can use for an advisor, and for simplicity's sake, I'm just going to say financial advisor. They have decided to go one of two routes, and I should say this: the really successful advisors have decided to go one of two routes. One could be a hardcore certified financial planner, or the other being an investment/portfolio manager. Okay, and it's challenging. So the certified financial planner, they're going to outsource their investment decisions through a fund-to-fund model, where the investments are taken care of through the product, and everything else, all the value add that the advisor brings, will be through the financial planning model. And the investment/portfolio manager will actually do the opposite, where they say, okay, we might hire a financial planner, but part of our value add is going to be the asset allocation, security selection, and the research. Okay, so that's becoming a much more difficult job, because as we can see from some of the research, it's getting harder and harder to generate the same amount of return from even 20 years ago. And the amount of volatility that you can expect with that same amount of return is going to be significant as well, significantly increased, I should say. So one of the other reasons why this has been put into place is, well, the valuation of practice. When you go through the book, it actually says a specialization leads to a higher valuation. It's a lot simpler for a financial planner to buy a financial planning book of business than a financial planning book with a little bit of investment management, portfolio management, and vice versa. There are people that are going to be very good at one of these aspects, and there are very few people who are good at both. So the more you commingle your practice, the less specialization, more generalist you are, the less value your book actually brings. So in the second part of worksheet, I should say, that we have here, again, we get them to talk about the passive index strategy. Some of the ETFs that they already know about, I want to get their minds primed for the discussion later on. If they're using them or not doesn't matter, but they at least should be aware of them. So when I talk about the passive and index strategies, what the current environment looks like, the trends, some of the mechanics, because they don't even understand how it works, and that's fine, neither do most people. EGA and ETFs, what they can and can't use, and then I'll give them some comparisons. So I fly through these slides, just first asset ETF growth versus the industry. During the during 2015, the international trends and growth in ETFs. Then we go through the ETF mechanics, and for the most part, it's pretty easy to understand. It's fairly similar to a mutual fund in the sense that you have a basket of stuff. You take the total price and get the NAV, right? Then we talk a little bit about trading, subscription, and redemptions, and the role of market makers. And then how do we keep the designated or the bid-ask spread as narrow as possible, typically through the liquidity of the underlying security. So we go through all that stuff. This presentation was specifically created for the Edward Jones channel, and they have their own rec list. They have a mutual fund focus list. In actual fact, they also have a ETF focus list where most advisors currently, as they transition from regular transaction accounts to fee-based accounts, they weren't even aware of it. So I got a copy of it here, and when we look at it, for the most part, it's all passive index ETFs. Nothing wrong with it, but that's what they're used to, and that's what the research is focusing in on, which I found very interesting. And the two highlighted ones I have here are S&P 500, so the Vanguard 500 ETF, and the iShares S&P TSX Top 60. So probably two of the most popular ETFs in Canada. So I go over XIU, and we just review some of the attributes of it. MER 0.18, tracking error is kept to a minimum based on concentrated index. Could lead to overconcentration. I'm basically showing them some pros and cons. Pro being low, very low MER, very low tracking error. So you're going to get index-like returns. And I'm also giving them a con, which is based on the concentration. You can have a Valiant situation where in 2015 it became 20% of the index, or Nortel where it became 33% of the index. If you're buying this product, you're going to get that kind of overconcentration. So I then give a comparison between that particular product and one of our Cambridge Canadian equity funds. And over time, there's a clear distinction of who the winner is. And obviously, we have one from a fund side, which is excellent. There's nothing wrong with the iShares product. It has a place for everything. There's a place for everything, I believe. It just, from a pure performance standpoint and a volatility standpoint, it looks like active manager and high fee fund can still win. Now, the second example I give is VFV, which is the Vanguard 500, S&P 500. This is super cheap, 0.08%. So again, start off with the pros. Tracking error kept to a minimum based on the broadest, most liquid market on the planet. So now when we do a head-to-head comparison between one of our Cambridge U.S. dividend funds and the Vanguard S&P 500, we lose. The point I'm making here is just Just because you're cheapest doesn't mean you're going to outperform a higher fee mutual fund. And just because we have great active managers, it doesn't always mean that we'll outperform a typical index ETF. Both types of products have a strength and a weakness. Worksheet number 3, again, I'm trying to get them to prime their minds for what smart beta is. I ask them for another name for smart beta, and it's factor-based or rules-based. Anytime you hear any 3 of these things, it all means the same thing. It's robots, it's algorithms that we've created as a company or other companies have created in order to invest in a certain type of strategy. So quickly going over the agenda: definition and example, historical and present day drivers of return, pay for expected performance, an example of MSCI World Low Risk Weighted. I took this straight from a few of these slides I've taken straight from Rohit, who is the national sales manager at First Asset. Factor-based investing, I'm giving them a minute here on this slide to just actually read what it means, and then I give them the explanation a little bit later on, which I'll go over with everyone on this video. I then talk about the evolution of ETFs. Again, VFE and XIU would be an example of simple beta. Equal weighted, so you just take out the overconcentration risk factor and then buy that kind of ETF. And then I tell them about factor beta, we talk about that, and then actively managed ETFs. And I draw the line here and say this is where we're going to make our living here at CI, where we focus in on the factor beta and actively managed. Then talk about one of our factor beta or risk weighted, low risk weighted ETF, and I have that triangle there, and I also have this printed out for the advisors, where I say this is essentially how it works. We take the MSCI World, and it's about 2,000 different stocks. We put on the factor screens, and then we can read over the box what those factor screens are, and then from that we say, okay, out of 2,000, what are the top 200 stocks that will be selected because of the screens, and boom, you create your ETF. I then go over some performance numbers and some events that have occurred versus the benchmark, and why this kind of a strategy and screening tool actually has worked. So, for example, we have Brexit there from June 8th to June 27th. The other example would be earlier in the year here, and from December of last year to February of this year, when China was closing, they closed their markets 4 times. So a bunch of world events, and we have significantly outperformed the benchmark overall. So I love giving them an example of things that have worked and sometimes fresh in their memory. So this is really the meat of the presentation. In actual fact, during meetings, if I haven't done the workshop with them, I will draw this out for a lot of advisors, especially if I know they are shifting from transaction-based to fee-based. And I go through this with the intention of really helping them shape how they construct their current portfolios. Typically, what I found is advisors who initially move from transaction accounts where the majority of the holdings are mutual funds, and then go fee-based, the fee-based account fee is typically higher. So where they might have been compensated about 1% trailer on a front-end fund, total MER of 2.45, if they go into, and again, this was created for the Edward Jones channel, a $500,000 account, for example, into fee-based, they would have to charge, or they're charging about 1.4 or 1.5 on the fee, not including extra MER. So the way they get around it is by blowing out mutual funds and selling only individual equities and index-based ETFs. So keeping the fees super low. In actual fact, I've been told by a number of advisors that it's the easiest sales job in the world, Mr. and Mrs. Client. I'm charging you 2.54 on your MER on the mutual funds. Tell you what, why don't we move it over to our fee-based account? I'll charge you 1.5 and I'll manage the stocks for you. So the client saves 1% in fees, and they get an advisor who's more highly engaged. So why this slide is so important is because I talk about how advisors are currently constructing portfolios in the big PM discretionary offices. The guys who you're just transitioning to fee-based right now. Well, these guys have been doing it for 10, 15 years. And here's the conclusions that they've come to. So the historical basis of this, in the 70s, if you had any kind of return, hey, good portfolio manager. In the 80s, there was a little bit more sophistication, thought process put into the into the portfolio construction process, and that said, okay, well, maybe you're not that great of a manager, maybe you're just in the market. So are you actually making more money on the upside and losing less money on the downside? So this separation of beta, which is market returns, and alpha. And further sophistication happened in the 2000s where you said, well, maybe there's a little bit more to this. Beta, you can make actually an advisor alpha where you're selecting where you're getting your beta. So it could be sector. So that could be something like an energy ETF. Country, like VFB, which is the S&P 500. ETF regional, which would be something like one of our ETFs at First Asset. It's a Quebec focused ETF. And then the separation of alpha is the further sophistication. So I bring it out and I say, okay, well, in the 2000s we said, or even later than that, were you really a good manager? You captured more on the upside when things were going up, and you captured less on the downside when things are going down? Or were you just in a selected mandate that we know can actually provide long-term growth over and above the market in general over time? So what do I mean by that? Typically, I give the example of the Canadian dividend fund manager in the 2000s. Were they really good managers, or were they just buying 5 Canadian bank stocks and sitting on their hands? Because if you did, you made a lot more money than the market in general over time. So the three that I focus in on for factor beta at CI and First Asset, I should say, that we have low volatility, value, and dividend. The other example I typically give is value, and I talk about the S&P 500, and then I talk about Warren Buffett. So if you take Warren Buffett's school of investing for value, low PE, low price to book, earnings per share surprises to the upside every quarter, etc., and you take the S&P 500, apply those screens, and you pick the top 150, that's what our ETF is going to look like. And then I talk about alpha. So for CI at least, when I look at the managers who are adding significant alpha, typically it has been Cambridge on the Canadian equity side, Black Creek on the global equity side, and believe it or not, Signature on the fixed income side. And then I go into what these advisors, these PM discretionary guys, are actually paying for this stuff. So when we look at the bottom half of this bar, all the different types of beta, that kind of product has become commoditized. You actually want the cheapest possible product out there because you want the lowest tracking error. So 0 to 0.25, 0 I included because individual stock will apply, and that doesn't cost any additional cost other than the fee-based, and then 0.25. And that passes the sniff test too when you go into either iShares or Vanguard and you look at what their ETFs are costing them. If they are true index ETFs, that's typically what you're paying. When I look at factor beta, you do realize there's some value. When a manager or advisor decides to go into factor beta, they understand that there is a chance and the strategy will perform better than the market in general over time, so that you're willing to pay a little bit more, anywhere between 0.4 to 0.75. And then alpha strategies, it doesn't matter. If you can prove it through numbers that historically over time that these particular managers have outperformed the market in general over time with significant upside capture and significantly less downside capture, then they're willing to pay more. The example that I give typically is, again, on the Cambridge Canadian Equity Fund versus the ETF. At some points, we're either 30 to 50% more than what the index and ETF has given you over a 5-year period, and with 20 to 30% downside capture only. And this is after fee. So that really speaks volumes to the power of alpha strategies. And it doesn't matter to them what, when I talk about the PM discretionary managers are doing, it doesn't matter to them what the cost is for a particular product at any given time. In actual fact, I cover 2 PM discretionary managers. They do and they don't care. Ultimately, the number one question that gets asked all the time is, can you make my model more efficient? And what that means is they already have the stuff that they're selling. And the 2 guys that I cover, the portfolios are on average about 17 to 21 different line items. So out of those 17 to 21 different line items, they have individual stock, ETFs, some smart beta, and on average about 3 funds. That's it. But they will hand over the portfolio and say, here is my current portfolio, can you make me more efficient? And all that means is, here's the stuff I'm selling, I expect X amount of return with this amount of volatility. Can you get me X plus a return, same amount of volatility? Or can you give me X amount of return with X less volatility? So give them more return, same vol, or same return, less vol. If we can add a product, whether it be alpha or factor beta, into that portfolio that does, you win. You get added to the portfolio. Otherwise, if the numbers don't support that decision, doesn't matter. And when I talk about, or when we do worksheet 4 and exploring and incorporating alpha, this is where I really get them to think about the quality of the managers, the quality of the products that they're doing. So what are some other managers that they're currently using outside of CI that have huge alpha? How are they achieving it, and will they be able to achieve it over the long term? So that's what worksheet 4 is. So what is alpha? Examples with CI, examples of modeling, and how to use technology to produce a more efficient portfolio. Again, this is straight out of the first asset deck. A little more information on the types of strategic or factor betas that they could purchase. And then I give them the words to use when talking about active mandates. So when I talk about PM designating manager allocating or winning an allocation to the Canadian Bridge Canadian Equity Fund, for example, and shifting assets from something like XIU, you are then moving them from a 0.17 MER to a 1.3 MER. How do you and how do they justify that? Well, ultimately, they can say this is an active alpha manager. Here are the things that you're getting with it: tactical asset allocation, security selection, and market timing. But also then saying it makes your portfolio or your model more efficient. You will get to your destination faster in a smoother ride. And then having the numbers to back them up. So again, I'm going to rehash this slide. We talked about what alpha is: tactical asset allocation, superior security selection and timing. And then I talked about it earlier. Who are the 3 managers at CI that can provide that? In what way? So I like including this quote because it doesn't necessarily get reflected when I do the comparison between some of the ETFs and some of the funds that we use, but it is part of the qualitative portfolio management alpha that Cambridge and Brandon Snow are adding to the funds. So that upside downside capture is pretty significant, but is it a fair comparison because of the cash weighting, the US weighting, and what have you? So this is when I get into models. Alpha over the past 5 years is incredible, 9%. Okay, this is when I get into the models, and I talk about some of the actual bank models that I've come across, and this is what it looks like. And then I talk about, this is the Edward Jones model, and then I actually bring up the fact that we have Morningstar Direct, which hasn't been as successful as I thought it was going to be. If they aren't in a PM discretionary model, Morningstar Direct doesn't really help them. They aren't there yet, so letting them I let them know that we have it, and at that point I say we can create models for you based on the Edward Jones models, which is something like this. We know how much, based on the risk tolerance, how much should be in each category, and we also know how much of our own product will fit into each one of these categories. I have created a few models, and Brad has them as well, that actually talks to this. It talks to the fees and the allocation to the different risk categories. I end it there, say thank you, typically have some questions, and then we're done. So thanks a lot for listening. Hopefully this is helpful.